Check out this wild year-to-date chart. Tech stocks are up more than 15% over the past 2 weeks and only about 12% off their all-time highs from right before the coronavirus really hit the United States. Joining us now to talk about where he's looking for opportunities is Mitchell Green. He is founding partner at Lead Edge Capital. Good morning to you.
Morning,
you look at these numbers, and there are some people out there that are scratching their heads.
It is fascinating. I mean, we actually ran an analysis late last week when you looked at like the top 10 components of the S&P, and from like mid-February to like last Thursday, they were down 7%, and the other 490 were down 25%, and that's obviously led by big tech, Facebook, Google, Amazon, Microsoft. I mean, it's actually incredible.
Fairly valued in your mind?
I don't think they're crazily expensive or crazily cheap. I mean, look, none of those companies have balance sheet risks, unlike a lot of the other companies in the 490. I think if you weren't, amazingly, we're hearing that new people are just coming on to e-commerce. So for Amazon is booming. People are sitting at home and using Google. Companies like Wayfair are experiencing tremendous demand because you sit and look at the couch at the end of the room. After a while, you're like, I need a new couch. And so I think, companies like Zoom, are great companies. I might argue they're a little, crazily valued at the moment, but it's a great company that's providing an amazing service in this environment.
Mitchell, what do you think about advertising-driven companies? I'm thinking about Facebook, and you had mentioned Google just before. We had Barry Diller on the program just last week, and I know this may be a particular segment, but he owns Expedia. That's a company that used to have a $5 billion budget for advertising annually. He said he'd be lucky if they spent $1 billion this year. You have to imagine that's going to happen across the travel sector, but I'd imagine it may happen in other parts of the economy as well, which would have a real impact, I would think, on the Facebooks and Googles of the world.
Yeah, it has surprised me how well Google and Facebook have actually held in there. Look, we're going to have a big advertising slowdown. I think the former head of AOL, who used to run Google's, was one of the heads of sales at Google, he said that he thinks this will be worse than 2008, 2009 slowdown for advertising. It probably will, because you're going to have sectors like travel, like consumer retail that have big slowdown. I think it's and I don't think it's just going to be only internet advertising. I think it's going to be advertising across the board.
We have Apple up on that screen. It's taken a beating. It's an interesting one because it does matter how well the consumer is going to hold up throughout all of this, given the price tag of some of the products and then, of course, the services. Where do you put that on your list of buys or not?
Apple's not a name that we know that we focus on really well. Look, it's an amazingly well-run company. That's very global, but it's hard to. We're not involved in Apple at all. Where we are seeing some interesting value, just to segue a minute, is in some of the small and mid-cap software companies like a SailPoint Systems or a Tenable. We were involved in CrowdStrike for a while, especially in the security space. Find companies that are not only you can get good value in them, but two, that are like critical infrastructure that companies are going to be, forced to buy, or that are not, discretionary purchases. Because in the world we are living in today, all companies, I don't care if you're affected or not, are, taking a really good look at their, CapEx budgets.
Right. Where do you land on Uber? It's an interesting one in this whole COVID world.
Look, so I own a lot of it. We own a bunch of it in our funds. We are slightly down on the position. What do I think of Uber? If you divide Uber's business into basically two things, Uber Eats and then ride sharing, and then think about it from a demand supply perspective. So look, demand for Uber Eats has never been better. You have huge numbers of consumers using it who have never used it before. You have tons of new restaurants that are signing up for it that have never used it before. But on the flip side, you then have rides, which are down 80+% in most major markets around the world. It's starting to recover in some of the markets in Asia, but of course, the ride sharing been decimated. It will come back as when cities get better, I think you're going to see less competition. I think you'll see more rational. Competitors. But actually, the most important thing for Uber is on the supply side of drivers. Uber, no different than a McDonald's or a Walmart or a Wendy's or Home Depot. Any companies that relied on lower wage or minimum to $10 to $20 an hour workers. Last couple of years, the economy, the labor markets have been really tight, and so companies, they couldn't find these workers. Unfortunately, now, right. For Uber, they have 25 million, people, so they'll be able to spend the billions that they were spending on driver incentives and driver recruiting, and those numbers are going to go away. So I like it over the next, 12 to 24 months.